Welcome, FRK 321. Today we're looking at hedging, lecture number 1. As a background, hedging is the policies and practices which an entity implements in order to protect itself against the risks that can arise from certain transactions. For example, currency risk. There are basically two types of hedging, the internal hedging and external hedging. As the wording suggests, internal being what the company does itself and various actions the company take, whereas external is like the FECs that we will work with. Take a look at that in your handouts. An FEC is a forward exchange contract, not foreign. A forward exchange contract is an agreement with a bank whereby a certain amount of currency can be purchased on a specific future date at a specified exchange rate, being the forward rate. Now the forward rate is quoted at a premium or at a discount on the spot rate. It depends on what you are buying, are you selling, and which direction the contract is stated. Let's look at the explanatory example. On 1 January 20.5, an entity purchased inventory from a foreign creditor for an amount of $10,000. The creditor must be paid in 3 months on 31 March 20.5. The applicable exchange rates were as follows: the spot rate and then the forward rate. Now, spot rate, we know that is the rate at which we will have to translate our transactions on the transaction date and on every year end. The forward rate is when we take out an FEC. The creditor is recognized at spot rate on the transaction date at 64,900 rands. And remember, your journal will then be debit the purchase of the inventories with 64,900 and credit the creditor with the 64,900. So we now owe the creditor a monetary item, the amount of money. On the settlement date, the creditor will be adjusted to the spot rate, since that will be the actual rand amount the entity owes the creditor, and that will be the amount which would be paid. So we first have to now restate the creditor at the spot rate on settlement date. That's why we take the $10,000 times the 653, and we now in rand value owe the creditor the amount of 65,300 rands. The entity will therefore make a loss on this transaction due to the fact that at payment date it was 65,300 and the initial transaction happened at 64,900, giving us the 400 rands loss. However, if on 1 January 20.5 the entity enters into a 3-month FEC for $10,000 at a forward rate of 1 rand equals 6 rand 50 to hedge the foreign creditor of 10,000, which must be paid on the 31st of March. What does this do? An FEC gives the entity the right to purchase this $10,000 in 3 months from now at a rate of 6 rand 50, irrespective of what the spot rate might be on that date. So we are actually fixing the exchange rate that we will pay. On the 31st of March, the entity will purchase $10,000 for 65,000 rands using the FEC. The entity that did not take out the FEC would, however, have paid 65,300, which would give them a 400 loss. But because we took out this FEC, therefore we are actually saving 300 rands, because we're only paying 65,500, whereas the spot rate at that date is 65,300. Now, since the entity hedged the creditor by means of a FEC, the net foreign exchange loss will only be 100 rand, calculated as follows. Now, you must remember, when we do hedge accounting, we actually have two transactions. The taking out of the hedge is a financial instrument on its own. So your FEC, your forward exchange contract, is a financial instrument. On the other hand, you are still dealing with a creditor, so the creditor is also in your books. So we will make two calculations. The first calculation is to calculate the exchange loss that the creditor made, and then the second calculation, we're actually calculating what happened with the FEC. And on the FEC side, we made a profit of 300 rands. So therefore, the net difference is what will be stated in our books of 100 rands, and this will be the net amount in the profit or loss. Hedge accounting is a voluntary accounting model prescribed by IFRS 9 financial instruments, and it entails the accounting treatment of hedging relationships. Now, an entity may only apply hedge accounting if it is the entity's accounting policy to apply hedge accounting and all the hedging criteria as set out on IFRS 9 have been met. Hedging criteria itself, that will be self-studied. Please refer to your handouts. It is in your handouts. Let's look at the terminology. A hedged item is an asset, a liability, a firm commitment, or a highly probable forecast transaction that exposes the entity to the risks of changes in fair value or future cash flow, and it is designated as being a hedge. For example, a foreign creditor which the entity has to settle on a future date, and for which a hedging instrument has been designated. That will then be your hedged item. So if you want to purchase an asset and you still have to order that asset, and now you're hedging it by way of a FEC, your hedged item will be that PPE asset that you are purchasing. From the above, it is therefore clear that when a foreign exchange transaction is being hedged, the hedged item can be one of the following, as we just said: a recognized asset or liability, an unrecognized firm commitment, or a highly probable forecast transaction. Recognized asset or liability. An asset or liability that was recognized in the accounting records in accordance with IFRS, for examples, a foreign debtor, a foreign creditor, or a foreign loan. What is a firm commitment? It is a binding agreement for the exchange of a specific quantity of resources at a specified price on a specified future date. Now, an example of a firm commitment is where the entity places a non-cancelable order for inventories. Or another example could be where an entity wants to purchase a machine which will take time to complete. You sign the contract and it is non-cancelable, and when it is delivered, then you take, of course, the asset into consideration. What is a highly probable forecast transaction? An anticipated transaction to which the entity is not yet committed. What is a hedging instrument? A designated financial instrument for which it is expected that the changes in the fair value or cash flow of this instrument will offset the future changes in the fair value or cash flow of the designated hedged item. So let's just do that again. A designated financial instrument for which it is expected that the changes in the cash flow of this instrument will be offset against future changes in the fair value or the cash flow of a designated item. As you saw with the creditor, which that illustrative example, on the one hand we had the FEC and on the other hand we had the creditor. The profit on the FEC was set off against the loss on the creditor, and that is what we want to achieve with hedging. Now let us look at the types of hedges that we can get. We get a fair value hedge and a cash flow hedge. The fair value hedge is a hedge against the exposure of changes in the fair value of a recognized asset or liability or an unrecognized firm commitment, and which is attributable to a specific risk, such as changes in exchange rates, and which can affect the profit or loss. The cash flow hedge is a hedge against the exposure of changes in the cash flow of a recognized asset or liability, an unrecognized firm commitment, or a highly probable forecast transaction, and which is attributable to a specific risk, as we said previously, changes such as changes in exchange rates, and which can affect profit or loss. In order to determine the type of hedge in the question, the entity's objective with the hedge must be established. Do we want to hedge the fair value of that asset that we are going to hedge, or do we want to hedge the cash flow of the asset? We in a question will state very clearly what is the objective, and you will then be required to do either a cash flow hedge or a fair value hedge. Don't be worried, it will be clear. Let's just look at the summary. Fair value hedge accounting applied to recognized asset liability and an unrecognized firm commitment, and cash flow hedges are applied to recognized assets or liabilities or unrecognized firm commitments or a highly probable forecast transaction. Let's just discuss those last two items. Unrecognized firm commitment. Once we have placed an order for an PPE asset or for another asset to be purchased, and it takes time to be delivered, it will be unrecognized until the transaction date happens. From that date onward, then you will recognize the asset on the one hand, and on the other hand, the relevant creditor or loan agreement or whatever the case may be. Against that, we have a highly probable forecast transaction. Now, if you are normally ordering your inventories from a certain company overseas, it's not a firm commitment, but it is a normal order. Then, because you are doing that very regularly, it will become a highly probable forecast transaction. Then the same principles apply. Once you've placed the order, it is highly probable that the transaction will happen. Once the risk and rewards have passed over to your company, then of course the transaction has happened, and then you will have the asset, the inventory, on the one hand in your books, and on the other hand the creditor. Right, good luck.